Right. We are now making a fairly significant change in what we've been talking about. Up until now, we've been talking about IAS and IFRS as it exists right now. We've been talking about the status quo. The financial statements you've seen are all prepared under the statements we've been talking about, IAS 32, IAS 39, and the likes. The rest of today is going to be a little bit of back to the future. We're going to be looking at what's coming in the future, what is still changing, and what's happening. As we do that discussion, I'll sort of mention from time to time some things are finalized and some things are still going to happen, some things are still going to change in the future, and we'll touch a little bit on that. Same format as before. If you've got any questions, stop me and ask questions as we go, because I think it's easier to deal with the questions as we go along rather than save them up to the end. This picture is quite important because it tells you about the status of where we are. So you'll remember, and I'll just flick ahead to a picture. I showed you this picture yesterday. And what this picture yesterday told you about was that we were starting with IAS 39, and we were moving from IAS 39 to IFRS 9. And we were doing it in 3 stages: classification and measurement, general hedge accounting, and impairment. Going back to slide 2, this one is telling you where we are right now in that process. So right now in the process, classification and measurement, you can actually do under either IAS 39 or IFRS 9. IFRS 9 is available, it's there, you can adopt IFRS 9 if you're a financial institution, although it should be said that IFRS 9 has not yet been endorsed in the EU. So although it's available to general IFRS users, it's not available to preparers preparing financial statements in the EU. So this diagram only works outside the EU, it doesn't work in the EU. Classification and measurement, you can early adopt, so you're allowed to use it right now. Hedge accounting, we're in the process of finalizing hedge accounting right now. Hopefully we'll have our hedge accounting final publication out in the next, I guess, month and a half. So that will be coming in about a month's time. Until that comes, only IAS 39 works. When the new hedge accounting document comes, equally you'll be allowed to early adopt that, so you'll be able to start using that. Impairment, we're going through an exposure draft process at the moment, so we've still got a little way to go on impairment. We're only likely to finalize the impairment in the middle of next year, and so it'll probably only be available for companies to use at the end of 2014. So the impairment stuff is very much in the process. Why is that important? It's important because it doesn't help me too much if you tell me about classification and measurement, other than some changes we're making already. I can listen to your views, but we're not really changing classification and measurement anymore. Hedge accounting, you can complain as much as you like, but hedge accounting is finalized. We're not making any more changes on hedge accounting, so that's finished. Impairment, though, we're still fundamentally looking at the process. So when we talk about impairment this afternoon, it's an open book, and you can tell me anything you like, and I'll be listening to you and taking those views back, and maybe making them as part of the changes that we think about going forward. I'll also talk right at the end of today a little bit about macro hedging or portfolio hedging and what we are doing in the portfolio hedging space. That's a completely different project, but it's useful to understand how that project is evolving, how it's working. All right, what is classification and measurement? What is the changes? What are we doing with IFRS 9? How's IFRS 9 coming into the classification and measurement space? Well, IFRS 9 is actually a different model or a different way of approaching the exact same thing. So things that we've talked about under IAS 39, like amortized cost and fair value and even fair value options, all of those things remain under IFRS 9. The stuff that Philippe told you about with IAS 32, what is a financial asset, what is equity, what is a financial liability, all of those things stay the same. So the basis of what you have actually learned in the last couple of days, the basis of what we talked about in the last couple of days, remains very much the same. What has changed is the way we think about the classification, the way we get ourselves into those different categories. When we talked yesterday, we talked about loans and receivables and held to maturity and available for sale. When we're talking today, we're talking about something completely different because the approach is different. The approach to thinking about those assets and liabilities is different. This slide is the core of IFRS 9. It's the most important thing in terms of what's changed with IFRS 9. What is this slide telling me? It's telling me I now think about assets not by the characteristics of the asset, but rather about the way that my business model works. I look at the way the business operates, and based on that, I will make a decision. Now, you asked me a question just now when we were sitting up here about why we would use amortized cost and why we would use fair value. What IFRS 9 recognizes is that depending on my business model, one method might make more sense or another method might make more sense. If my business model is to collect cash flows, amortized cost tells me all I need to know about it. It tells me what the balance is of the cash flows I am still going to collect. Fair value tells me nothing because I'm not going to sell the asset. I can't sell the asset. Nobody would buy the asset from me a lot of the times. So fair value is not relevant in that business model. But if my business model is to buy and sell assets, well, in that case, my business model is trading, and fair value tells me everything I need to know about that asset. It tells me how much I'm going to sell the asset for, what I'm going to earn as income from that asset. So this is the core, and I'll get into some of the details now when I talk a little bit more about IFRS 9 and how it actually works. But if you're going to keep one slide, and you're going to make it into a poster, and you're going to stick it up on your wall, that tells you what IFRS 9 is, this is probably the slide that you want. And then just now I'm going to tell you how we're going to change the slide. So never stick anything on your wall with permanent glue if it's IFRS, because it might just change. Alright, what are the main changes that IFRS 9 makes from IAS 39? It reduces complexity, so we've tried to make it a lot less complex a model. And examples of that are the single impairment model disappear. We have a single impairment model. Instead of having impairment models for each different type of financial instrument, we now have a single impairment model that works across the whole of IFRS 9. Embedded derivatives. You remember we had that big discussion yesterday about bifurcation and how we cut this thing and how we decide when we can cut it and when we can't cut it. Bifurcation is gone. There's no more bifurcation in IFRS 9. We align measurement of financial assets with the business model. So we look at the way the company manages its assets. We don't look at the characteristics of the assets themselves. Now that in some ways can be quite complicated. It means that I can have the same instrument. Let's say I buy a government treasury bond. So I buy German treasury bonds. Those German treasury bonds I buy could be held at fair value because my intention is to trade them. I'm buying and selling them, so they're a fair value because that's my business model. Or they could be held at amortized cost because my business model is to collect the cash flows over the life of the bond. So the same instrument can reflect two different things, or can be reflected at two different values. But the underlying logic of it, the logic that what a user of the financial statements wants to understand is what is the most likely cash flow I'm going to receive. If I'm going to collect, it's the collection of cash flows. If I'm going to sell, it's the fair value of the instrument. That's the logic that underpins it. Hopefully also under IFRS 9, and we'll talk about this a little bit later, we've now fixed own credit risk. And I'll explain what own credit risk is a little bit. And the tainting rules. Remember we talked about the tainting rules, that if you break the tainting rule, you go into the penalty box, you get punished, and you can't use held to maturity for 2 years. And then suddenly you can use it again. We had all those reclassifications that were going back and forth, because now it's tainted and now it wasn't. The tainting rules are gone. So the idea was to take that IAS 39 and simplify it as much as possible. Take out some of the things that were rules and try and replace them with principles. Have we been entirely successful? We're not quite there, because there's some complications we'll talk about later that mean we've had to introduce some rules to fix those complications. But we'll talk through that as we go through the process. Okay, so what is a business model? A business model simply talks about the way I manage my business. If I have a business model of collecting contractual cash flows, then I have an amortized cost business model. My intent is to collect the cash flows over the life. You don't look at every instrument you buy and decide, well, what is my business model for this instrument? What is my business model for the next instrument? You look at the way the business operates. So what is the business that it goes into? And this is not about intention. I can't say what is management's intention with a business model. A business model is a business model. It's visible because you can see how they've accounted for that particular business in the past. If my business is a mortgage loan business, it's apparent from the way I manage my mortgage loan business that it's a hold to collect the cash flows. It's apparent from the history of the way I've dealt with it. It's apparent from the way I decide when to pay bonuses and when not to pay bonuses. So all of those things are telling me what the business model is. I don't look at the instrument by instrument. I look at the environment in which a particular instrument is going to reside. I also need to look at the contractual terms of instruments, because sometimes contractual terms will tell me a story that is not necessarily available in the business. So I need to also understand that part of it. So what are those terms? The contractual cash flow characteristics are things that tell me about an instrument, tell me things about the instrument that might be different from what the business model is actually telling me. So remember when we spoke yesterday about derivatives, and we touched on derivatives earlier this morning in response to a question. What I said about a derivative instrument is the problem with a derivative instrument is that amortized cost is meaningless. It tells me nothing about that. It is actually irrelevant, because on day 2, and think about the example when we were looking at the fuel oil derivatives yesterday. They can go minus, they can go plus, they can swing huge numbers, even though the amount that I've invested is very small or zero. So amortized cost would be zero of a derivative, but the movements would be very big. When we look at contractual cash flow characteristics, we're looking for the same thing. We're looking at the instrument and saying, is this instrument solely principal and interest? Is the instrument just about the fact that I'm going to receive back my capital and I'm going to receive interest over a period of time? Okay. If that is the characteristics of the instrument, capital, interest, then amortized cost is relevant, and the fact that coupled with my business model, it appears that I'm going to collect the contractual cash flows, that's an amortized cost instrument, and we're happy with that. Remember that interest is not just time value of money though. So when a bank decides to charge me 20% and it charges you 5%, why is it distinguishing between the rates? It's distinguishing between the rates because there's different risks between us. So when we talk about interest, interest can cover a bunch of things. It will cover the fact that there's different credit risk between two different parties. It will cover the fact that there's a period of time, the time value of money. It will cover the liquidity risk. So if I advance you a loan for 20 years, or I advance you a loan for 1 year, I'm going to charge you different interest because there's a different liquidity profile for those two. So when I'm thinking about interest, I must think about the fact that interest already includes all those things. So as long as I'm receiving principal, as long as I'm receiving interest, including all the things that interest includes, then this is an amortized cost instrument. Okay. So bearing in mind what I said a moment ago, I said that in order to qualify for amortized cost, you have to have both of these factors in place. Your business model must be hold to collect, and your instrument must reflect hold to collect. I think you asked me a question yesterday about the particular instruments in a jurisdiction where I have advanced money in euros, but it's repayable in Swiss franc. Okay. So what I've got is I've got two different currencies at play here. Because I've got two different currencies at play, I can't call this solely principal and interest. I'm receiving principal, interest, and something else, a currency derivative. Okay. I said there's no bifurcation under IFRS 9. So because there's no bifurcation under IFRS 9, I have to take that whole instrument and treat it at fair value. So if you know of instruments in your jurisdiction, if you know of instruments that are being treated like that, and I can think of a couple of instruments that have already been raised with us, a couple of concerns, and Eric mentioned one, which was the Danish example, where Denmark has come to us and said, look, we've got a problem. We think these instruments might actually have to be carried at fair value, and we don't think that's the right reflection. And I'll talk about what we're doing about it a little bit later. Yes? Okay, the variable interest rates, and it's a really good question. So the question here is, are variable interest rates contractual part of P&I? And the answer is absolutely, as long as they are linked to something sensible. So if I say my variable interest rates are linked to LIBOR, or I say my variable interest rates are linked to the base rate in my particular country, actually I suppose I shouldn't use LIBOR anymore, that's like a swear word, isn't it? So let's say it's linked to something else, it's linked to some sort of index, then absolutely, that is purely reflecting the time value of money, and so it is a normal interest rate I can treat. However, if it is linked to the equity price of BMW, well, that's got nothing to do with the time value of money. That's absolutely, totally irrelevant to the time value of money. What I have in that circumstance is I have a loan, and I have a derivative instrument on BMW's share price. I'm picking on BMW today, I'm not too sure why, but what that all brings together is it brings the fact that there are going to be some instruments that people think about as normal instruments, okay, that actually might not be normal instruments. And I'll give you an example from Europe that might help people understand what we're talking about. In France, there's an instrument called the Livret A, and I think there's a Livret B as well. These are instruments where what you do is you take in deposits, generally speaking from, I think, French nationals. You offer them an interest rate on those deposits, but the interest rate is not determined by reference to the market. The French government decides what that interest rate should be. There's a formula, but the French government can override the formula. Why? Because that's actually a policy tool. It's a policy tool the French government uses to try to encourage people to save. Now the bank's got a risk. The bank's got a risk that it's suddenly got this interest rate that relates to nothing. So the French government assists with that risk by allowing the banks to redeposit that money with them at the same rate. So the bank says there's no problem. The hassle is because that interest rate is an artificial interest rate, it doesn't reflect the reality of the markets. It's not the same interest rate that you would normally get for other instruments. It's therefore not reflecting time value of money, it's actually reflecting a monetary policy. We would argue it doesn't qualify here. It's not PNI.
If our deposits were, for example, in fixed rate, and our loans are linked to something that doesn't have to do anything to do with the fixed rate deposits that we have, and we give out loans Euribor +3, would that then be an embedded derivative for this kind?
No.
Because our source of our financing is totally different than
So it brings up a very important concept in the way IFRS works. And IFRS says you look at your assets and you look at your liabilities, but you never look at your assets and your liabilities. IFRS, remember, applies to transactions. It's a transaction level accounting. It's not entity level accounting. So in the circumstance that you've raised as an example, I would look at my assets and I would say, is this a representation, the fixed rate I'm receiving, is this a representation of the time value of the money at the point in time that I advance the asset? Yes, it is. I'm lending it at normal rates, taking into account all these other things like credit risk and liquidity, but I'm lending at normal rates, therefore my asset is fine, tick. Then I go to my liability, and I look at my liability, and I say, what rate am I paying here? Is that rate a reasonable reflection of the time value of money? Yes, it is. It might be variable and fixed, but they're both reasonable representations of the time value of money. So you would in fact treat both of them as, they're both qualifying.
I have questions that relate to Europe. China has a system where the central bank regulatory committee sets the interest rates that banks are allowed to charge. So the logical conclusion would be in China, all loans will be at fair value to profit and loss.
So I'm going to answer that question in a complicated way.
Not in Chinese.
If I could, I would actually, just for fun. But so central banks in many countries set interest rates, and if you set interest rates, if a central bank sets the interest rate, that becomes the interest rate of the country, generally speaking. Okay, so generally speaking, if the central bank in the UK changes the base rate from 5% to 6%, by doing that, what they've done is they've actually changed the time value of money in that particular jurisdiction. So normally, if the time, and the way they do it is they've got a whole lot of mechanisms where, for example, they create an artificial shortfall. The artificial shortfall forces banks to invest their extra money with the bank, with the central bank, and so whatever rate they get is the rate they charge. So in most normal circumstances, you would say that the central bank's rate setting the central bank rate, doesn't actually, what it does is it actually changes the time value of money. So if you're consistent with that central bank rate, you're actually consistent with time value of money. China, unfortunately, does something very odd. What China says is that if you have a 5-year loan, this is the rate you will charge. If you have a 3-year loan, this is the rate that you will charge. If you have a 5-year loan with only 3 years to go, you don't pay the logical market thing, which would be the 3-year rate. Under the Chinese legislation, you pay the 5-year rate. So the problem with the Chinese legislation as it stands at the moment is it is too artificial. It creates too artificial a situation. It doesn't reflect time value of money. So right now, as things stand, under this particular standard, China would be required to fair value everything. Significant problem, obviously, and we can imagine that the Chinese are not particularly happy. For that matter, nor are the French on the livret A thing. So it's the same logic that comes through. It's just that in the French example, it's a logic that only applies to one product type. In the Chinese example, it applies to the whole economy. So what we've said is that in the exposure draft that we've got out, that's just the classification and measurement exposure draft, we've asked people about how should we deal with this. And we'll be discussing that over the next couple of months in terms of different ways that we might possibly deal with it.
Just wanted to say that not very far away from China, here in the Balkans, all of those loans that are indexed to Swiss francs or euros are indicated to go to a fair value loan portfolio, which is not something they are handled. It's not the business model. It's just a reflection of the new standard in place, and therefore I don't know how it's going to be applied, because it's very difficult to find the fair value. And the second thing, just for the remarks, not only China sets the interest rates, but also the management boards in this area are entitled to change interest rate as they like. So you can have fixed rate, you can have variable rate due to Euribor, I don't know, LIBOR, whatever you want, but you can have it administratively kind of variable rate, where I, as a management board, decide I like some, interest income, so I'll increase it. No market, just pure decision making of the...
So one of the questions that then becomes important is, how does that actually get used in practice? So and we spoke yesterday about substance over form, and how you need to look at the substance of a contract, not the form of a contract. Sometimes we have in various places what appears in accounting, or what appears in contractual law, is something that has no commercial substance. Now, what you find, and many banks, in fact, across the world, have the ability to change interest rates if they so choose. If they did it, they'd probably go out of business. Because who wants to lend from a bank that just decides, today I'm charging you 10%, but tomorrow I'm going to charge you 15%. So what you have potentially is a term that has no commercial substance. It's there, but it can't actually be used. Because what I do, very simply, is I would say, I go to the bank next door, borrow money at 10%, pay back the money I owe you.
All the banks do that. Come to Croatia.
Okay. So here is, and this is why then maybe what becomes important now, and hopefully, as I say, where we are in the process, and we'll get to it a little bit later, but I'll cover it a bit now. What we've done is we've actually reopened this classification because people were experiencing problems with principal and interest, and we've asked people to tell us. We've tried to fix it a bit, and one of the ways we fix it is to say, look at the way it plays out in real life. How does it actually act in real life? And if in real life it acts like an instrument that's a normal instrument where you're charging benchmark interest, then you can actually use that. You can actually apply P&R. But we've put this out there and we said to everybody, come back and tell us. So hopefully the Croatian banks, hopefully the other banks that are involved here will have come back as part of this letter writing process. And we start talking about this again next month. So we will be re-talking about this in terms of whether the solution that we've provided is sufficient, or whether we need to provide something more.
When we actually push fair value requirement for instruments, for example loans, which are not regularly bought and sold in the market, and so there is no explicit market values for them. Under IFRS 13, we would go to the third level and decide fair value for them. So probably the most reliable fair value would be based on the cash flows. So we might end up with the same thing, but with a different name, that now they are fair values.
So we could end up with a very similar answer, you're right, except bear in mind that what you've got to take into account. So if I were looking at a normal loan, present value, normal interest, I present value it at the EIR of that loan, I get exactly the value I stock. Fine, very happy. If I look at an instrument that's got something odd in it, something unusual. So to take your example, it's a loan at normal interest rates, but I as a bank am allowed to push the interest rate up if I want to. What I then need to do is I need to do my present value of all the cash flows at the EIR, so at the rate I've got now. But I have to model the fact that some of those cash flows might be higher. And they might be higher because I charge the additional interest rate. That's going to give me a different value. And if you think about it, you stop and think that if I can, at any time I want to, increase the interest rate of a loan, just change the interest rate and make it higher, then I have an instrument that is more valuable than a conventional instrument. And that's what's going to be reflected in the numbers.
So the difference we will recognize in profit or loss immediately?
The difference would be recognized now, because what you're going to do is the day that I advance the loan, okay, what I've got to do is I've got to look at my cash flows there, okay, the cash flows I expect there, and discount it back today. That gives me my EIR today. That EIR then works all the way through. So the only time I'll recognize a profit or loss is if my expectations change. I expected to increase the interest rates, and I didn't, that's a loss. Or I expected not to increase the interest rates, and I did, that's a profit. But then I'd recognize the profit immediately.
But what we do now, for example, loans with underrated interest, we do the same, right? Because now we recognize at fair value, and then it just affects the effective interest rate because of the cash flows. So even if it's an odd loan, actually I can see the difference, what this requirement changes for now and if we apply IFRS 9.
This requirement won't change anything on day one. It will change things when things change. So as I go through time, something changes. But if I were to think now about how IAS 39 works for these instruments versus how IFRS 9 works, IAS 39 says cut this instrument into two. The right to increase the interest rates is an embedded derivative, and I would treat that embedded derivative as a separate element, and I would fair value the embedded derivative, and I'd keep the host contract at amortized cost. Under IFRS 9, I have no bifurcation, so if the entire instrument fails the test, if I have an embedded derivative in that instrument, I must fair value the entire instrument. And the logic behind that change from IAS 39 to IFRS 9 is that when you do this cut, it's artificial, it's not real. I can't sell one piece of the instrument and keep the other piece of the instrument. I can't stop one piece of the instrument and keep the other piece. It's actually one contract. And so IFRS 9 just reflects it as one.
So can we sum up that what we would do on only first day before this IFRS 9? Now we will have to do it every day, because if the market rates change and we have difference in fair value and what we have in our balance sheet, so this is what we did on the first day of loan, what we should have done.
No. Under both IFRS 9 and IAS 39, you'd have to revalue it every day. The difference is under IFRS 9, you revalue the whole instrument every day. Under IAS 39, you bifurcate it, and then you revalue the piece that you had bifurcated every day. So it's simply the unit of account that changes between the two standards, not the whole process that changes.
Okay, thank you.
So just to add to, at the end of this discussion, the real concern is the second requirement regarding the interest in cases which are so common in our economies. So I think that although it might sound reasonable from the accounting point of view, these cases or these loans to be measured at fair value and remeasured on a timely basis, and then comes again the question, the difficulty of measurement of the time value. We as the regulators and maybe even the bankers from the risk management perspective would be mostly concerned that this portion of loans will exit from the regular credit management procedures, credit impairment procedures. So I think that from the supervisory perspective, and maybe even from the bankers, from the practitioners within the risk management units there, they will be mostly concerned I have loan, and I don't manage it as loan. I manage it on a fair value basis, and it goes out of all my well-established credit impairment procedures.
And I think you're understating it. I think the preparers who have understood what this means are having heart attacks about it. They're not just a little bit concerned, they're very concerned about it. And that's why, as I say, that's why we opened IFRS 9 again, why we opened this phase, was to look at exactly this problem. So the Danish were one, but there were many other banks that came to us and said the way it was written here is too strict, it's catching too many things. So the process we went through in the last couple of months in changing IFRS 9, and say we'll talk about that a little bit, but I think we've covered most of it, so we'll be able to skip through those slides. The process that we did there was to try and make sure that it was more broadly open, that it accepted more things coming in. Now the questions that we asked when we issued the thing, and we issued it in late December, so the closing date was middle of April, but what we did was we asked people, does this cover? Are there any normal instruments that you're normally trading, the kind of stuff you're talking about, where you manage them as amortized costs, but suddenly now we're forcing you, tell us what those instruments are and let us understand it. And exactly the discussion we're having now is a discussion the board will have over the next 3 months, is to talk about whether there are instruments that, even though we soften it, are still getting caught.
Just a little bit to add just a little bit flavor to this discussion. Just as a quantitative measure, in Macedonia, more than 80% of deposits bear such kind of interest rate, which is subject to a volatile management decision to change.
And do management actually make those changes?
Oh, yes. Yes. We have tried to measure the frequency over time. There is no regular frequency. It depends on the economic, macroeconomic conditions and things like that.
So
No. Our conclusion was that it was not driven by a profitability reasons, but mostly it was driven by the trying to get more of the market.
So they increase the interest rates rather than decrease them. It's a competitive thing.
It depends. Yeah, it's
Look, I think
always based on the competitive
it raises
decision.
a very good point, and it's one that I would be keen, and maybe we can pick it up afterwards, or maybe people can send me emails on the details of these instruments. I'd be keen to have a look, because on one hand, if I'm doing it just for profitability, what I'm doing is I'm bumping up rates and doing that. That's one thing, because that actually suggests I've got something of value, the ability to bump up and change rates. If I'm simply doing it to try to reflect the competitive environment I'm in, to be able to lend more into that environment or to be able to raise more deposits, then what that's doing is those kind of changes drive the market. So they reflect the time value of the market. It reflects the changes in the time value. That to me is an answer I'm much more comfortable with. I'm far more comfortable with saying that should be at amortized cost. Because I haven't got something of additional value. I've simply got a tool that allows me to more closely reflect the market. Then I'm happy, and then I think the changes might actually accommodate that. But say, if I'm just able to say, I lend you the money at 10%, and tomorrow, hey, by the way, I want 15%. And this is cool because that means I get a bigger bonus. That sounds to me like I'm getting into a space that worries me, because that does feel like an embedded derivative. It does feel like something more complicated. Okay.
I have one question and a holy promise not to ask more than 3 questions the rest of the day. So I have my... I have been out of accounting a little bit because I was kind of absorbed by the CD4. Do you think that actually declassification into amortized cost has become more restrictive? Because in current IAS 39, you only have the business model test in a way, no? I mean, it's either held for trading or loans and receivable. As far as I know, there is no characteristic of the instrument. So whenever you have these loans, and that was your business models, that's where you put it. Now the IASB has come forward with, yes, you do the business model, but in addition, and actually as an override, as I see it, you have to look also at the contractual cash flow. So my conclusion would be it has become somewhat more restrictive on actually, and was that a purpose?
So the answer there is yes, it was on purpose. Yes, it has to an element become restrictive. But let me just confirm something you said earlier. You said IAS 39 didn't have something like this. IAS 39 did have something, but what IAS 39 said is bifurcate. Okay, and so what you did under IAS 39 is you split this instrument into two. You fair valued the one piece and not the other piece. What IFRS 9 says is that same instrument that you bifurcated before, you've now got to look at, and if this is still a significant element of the instrument, it goes into fair value. Where it's less restrictive, so it's a bit more and a bit less, where it's less restrictive is the fact that under IAS 39, any embedded derivative had to be bifurcated. You had no choice, you had to cut it. Under IFRS 9, we're a little bit more relaxed in when you have to bifurcate. And if you only have a small or a very unlikely embedded derivative, you wouldn't fair value the whole instrument for it. So it's a little bit of both, to be honest. But yet it was a subject to considerable discussion, and were the ramifications understood? Absolutely. Okay, equity instruments. What we said with equity instruments under IFRS 9 is that usually equity instruments will be prepared at fair value. It would be shown at fair value through profit and loss. However, we've added in an alternate presentation, and we've simply said that if you have equity instruments that are not held for trading, so your intent is not to hold them for trading, you are allowed on an instrument by instrument basis to choose to put the movements in it through OCI. Okay. There's no recycling, so once it's gone into OCI, it lives in OCI, it never comes back into profit and loss. Why did we make this decision? We made this decision because some companies pointed out that they have, for example, an investment in their supplier. So they've invested 5%, they bought 5% of the shares of their supplier. They intend holding those shares for 100 years. They're never going to sell the shares. There's no intent to sell the shares. So let's take an example. Apple Computers. And Apple Computers has got a supplier in China that actually builds its iPhones. Okay. It has a small investment in that producer in China. I forget the name of the producer now, but I'll think of it in a minute. So again? Foxconn. There you go. So they've got this. You've got this relationship. There's an investment. Apple is not going to sell that investment. So the profit and loss on that investment as those shares go up and down is meaningless in their results. It doesn't mean anything. But the problem with equity is amortized cost for equity is also meaningless. So what we said here is we want the fair value of the shares. We want to understand the fair value of the shares. But we agree that changes in the fair value of that kind of investment are not performance. They don't tell me anything about performance. But we put a sting in the tail. So we said even if Apple eventually sells those shares, they can't recognize the profit in profit and loss because it was never their intention that that should be part of performance. So they can't suddenly produce a profit. So you need to think very hard if you use this category, and we suspect over time many people will choose not to use the category, and hopefully it will only be those sort of strategic investments that use it. Embedded derivatives, simply hybrid contracts here. If you have a financial host, so if it's any kind of loan agreement, anything we would normally deal with in financial instruments, there is no bifurcation. There's no bifurcation of it. If you have a non-financial host, so if I have an embedded derivative that's attached to my purchase of, let's say, inventory. So I say that when I buy inventory, I will buy inventory from my supplier at the fair value, but I agree that I will never buy inventory from the supplier for more than $100. So if the price goes up above $100, I'll pay $100. That's an embedded derivative. I've agreed to buy something from the supplier. I will buy something from the supplier at whatever the value is. However, if the value goes above a certain amount, I won't pay more than that. In that circumstance, because it's a non-financial host, it's inventory. Okay. In that circumstance, I can strip out the derivative and treat the derivative separately. But for financial hosts, there's no more bifurcation available. The fair value option that we spoke about yesterday under IAS 39, what we've done here is we've limited when you can use the fair value option. So yesterday I said you can use the fair value option to avoid bifurcation. You can use the fair value option if you manage something at fair value basis. Both of those now disappear under IFRS 9. The only time under IFRS 9 you can choose to value something at fair value is to eliminate a mismatch. When do I eliminate a mismatch? I eliminate a mismatch if my liability is at fair value, My asset would otherwise be at amortized cost. I want to measure the two the same, so I'm allowed to choose to value that asset at fair value. Okay, so application guidance in terms of some of the things on financial assets. We've given a little bit of help for people where you can't actually value an equity. So let's say I buy shares and I buy 100 shares in an unlisted company who's my supplier. I don't know how to determine fair value on that because it's too difficult. In that circumstance, our application guidance says that cost might be an appropriate number, but you have to be really satisfied. We put you through the application guidance, put you through a lot of loops. You need to look at the NAV. You need to not have access to NAV, not have access to dividend flows, not have access to financial statements. Now, if you don't know what the NAV is and you don't have access to the financial statements and you don't know how much the dividends are, you kind of do ask the question why you invested in the first place. But that aside, there are circumstances when you can use cost. All right, so what's changed? We've covered a couple of the points. I just want to touch on them again. IAS 39 is rules-based. This gentleman over here yesterday asked me a complicated question about options and how options were, and in that discussion he admitted to the fact that he had read IAS 39, and I was very impressed by it. So David Tweedy, who was the previous chairman of the board, said that if you've read IAS 39 and you understand it, you haven't read it properly. Okay. IAS 39 was very rules-based, very complicated, very back and forth. IFRS 9 we've tried to make it principle-based. We've tried to make it broader, make it easier to understand, make it easier to work with. From a measurement perspective, we've added this option for equities and how you treat equities, so that's a change. Impairment, the rules of impairment are going to be, under IFRS 39 we had different rules for different instruments. Under IFRS 9 we'll have a single rule. You'll only have one way of calculating impairment, no matter what the instrument is that you're looking at. There are no tainting rules under IFRS 9, so that's a big change. Under IAS 39, we talked yesterday about the reclassification rules. You remember we had that table after table where I said this in and that out, this in and that out, and it was complicated. It was rules. Okay. Under IFRS 9, and that was, you could choose to reclassify. Under IFRS 9, we simply say, if your business model changes, you have to reclassify. If your business model does not change, you may not reclassify. It's a principle-based approach to the whole thing. Embedded derivatives bifurcation we've talked about, and fair value option we've talked about. So those are the really big changes there. So just a couple of illustrations. Equity investment. If an equity investment is held for trading, it's fair value through profit and loss. If it's not held for trading, you can irrevocably choose on an instrument-by-instrument basis to either take it through fair value or take it through OCI. Irrevocably, big word. Choose once, never again. You're stuck with it after that. So it is quite a big onerous test to actually do. And remember what I said about it doesn't come back through profit and loss, so people will be taking this choice very seriously. A debt investment, if it's held to collect contractual cash flows, amortized cost. If it's not held to collect contractual cash flows, it must be fair value. Simple test, A or B. A debt investment, but now it's a complicated one. It has an embedded derivative, and it sounds to me like the front table might have quite a lot of ideas of these instruments, so it's potentially any of these kinds of instruments we're talking about.
Can I choose the same type? Can I choose the same type of, for example, asset, financial asset, to measure fair value and amortized cost? For example, I have treasury bills.
Absolutely.
And
so if you have
the
two
same
different
treasury bills tend to take in fair value and 10 amortized cost.
Remember what we said though, it's about the business model.
The business model don't cover the whole type of the same assets.
Correct.
Just asset by asset.
But let's assume that I have now, I've got two departments in my bank. And the one department is my liquidity department. They're responsible for managing my liquidity. The other department is my trading department. When I look at my trading department, it's obviously a fair value department. So when it buys that treasury bill, it's going to fair value. My liquidity department is buying in treasury bills in order to meet the regulatory requirements. They want to keep those treasury bills in there until maturity. therefore it's amortized cost. Same instrument, two different ways. Okay, hybrid instruments, if it has P&I cash flows and is held to collect the contractual cash flows, the whole instrument is at amortized cost. All other instruments, so they no longer P&I cash flows, they're now something else, must be at fair value through profit and loss. And this is precisely the issue that we were concerned about. Okay, liabilities. All financial liabilities are at amortized cost, okay, except for those held for trading. So I can only put something in, I can only put a liability into fair value if I'm actually trading in that liability. But trading in liability is a very difficult business, a very difficult one to understand. But somebody here asked me the question yesterday about the situation of a central bank or a bank that issues its loans into the market and then makes market in, buys them, reissues them, buys them, reissues them on an ongoing basis. That feels to me like a trading strategy. And it feels to me like those liabilities might need to be carried at fair value. So that's something you would need to look at. If you're making a market in your own debt instruments, buying and selling them continuously, that might just be a fair value situation. You might need to look at it as fair value. If I carry my financial liabilities at amortized cost, I still have the choice to adopt fair value option if it will eliminate a mismatch. Now this is a far more common mismatch. I have trading assets, my trading assets are trading all over the place, I have to carry them at fair value because I'm trading in the assets. I've funded those assets with, let's say, deposits or with certificates of deposit. So I've got a liability that's funding the assets. I'm not trading in the liability, I am trading in the assets. My assets are at fair value. This allows you to say that my liability can be at fair value as well. Okay. But in this circumstance, I'm not trading the liability, but I'm carrying the liability at fair value. If there are movements in my own credit, I take those movements through OCI. And let's talk a little bit about own credit. What is own credit? Okay. Own credit is the situation where the price of my liabilities changes because of my credit rating. So take a simple example. I've got a bank. My bank has got a AAA rating. It's a really cool bank. It's good. It's awesome. It's well regulated. Everybody's comfortable with this bank. Okay. AAA rating. I'm paying 0.1% interest rate. Everything is fine. I have a huge loss because I got my credit management wrong. The huge loss means that I show a loss in my income statement. My rating goes from a AAA to a BBB. My interest rate goes from 0.1% to 10%. The value of my liability in that circumstance drops. People will pay less to buy my liability. So the liability that I was recording as 100 in my balance sheet now goes from 100 to 80. I've got a 20 change in liability. Think of the journal entries. In order to make a liability smaller, I debit the liability and I credit something. What do I credit in this circumstance? I credit profit. So I've got a profit of 20. So because I actually mismanaged my business and I made this big mistake, I have a profit. The exact same thing works the other way. If I now manage the business very well and I improve it, that 20 is going to go through the income statement as a loss. I'm going to reflect a loss to show that I'm managing my business better. So if you fair value your liabilities, IFRS 9 says, using the fair value option, so this is not a trading liability, it's a liability that sits on my balance sheet as a normal long-term liability, but I've chosen to fair value it. The movements in own credit go through OCI, they don't go through income. They're not a performance indicator, they're something else. Trading liabilities, on the other hand, do go through profit and loss. Why? Because it's my habit to buy and sell those trading liabilities. I can actually buy it, and I can actually make the profit. I can make a real profit doing that. Okay, my whole bank might be falling apart around me, but I can make a profit trading in my own liabilities, and so that would be reflected there. So in essence, by simply taking this own credit through the own credit of fair value option liabilities through OCI, I'm still recognizing the fair value in the balance sheet. That's the correct number to recognize because it is the real fair value. But I'm not reflecting the changes in fair value as part of my performance indicator for the bank. And we talk a lot about, there's a lot of IFRS 7 disclosures that go with this that tell you a little bit about what's happening and why it's happening. Okay, that's just some detail on it, so let me jump straight in. Okay. So that is in essence IFRS 9. That's what IFRS 9 is doing. And the important thing with IFRS 9 is we're not changing the world. All of the concepts you learned about yesterday, all of the things that you got the hang of yesterday with IAS 39, the things you're seeing in financial statements, remain roughly the same. What we're doing with IFRS 9 is simplifying it, making it more principle-based, and making it based more on the way the company is managed than on a bunch of rules about instruments. That's the point about IFRS 9. Okay. Classification and measurement came back to us, and it came back to us for precisely the reasons we heard about here earlier. People were thinking that those rules on amortized cost, those principles on P&I, were too strict. What we had done is we had said, P&I is the principle. And then we had said, this is how you know P&I when you see it, and we've written a whole bunch of rules to make it very strict. So we reopened this one to have a look at this and see whether it was possible to simplify it, to make it easier for people to use, and to make it more practical for the Danish banks and the others who've got those type of products. So what we were looking at, limited modifications. We were comfortable IFRS 9 worked. We were comfortable from what everybody told us, that it was broadly right and they were broadly comfortable with it. But a few specific issues had been raised from people trying to apply it that we were trying to address. We also used the opportunity, and this is the first time I'm going to be using these words in 2 days, and they're quite scary words in the realm of the IASB. Convergence is something we think about. Convergence is something we're trying to achieve. It's the monster in the room. It's the 500 kilogram gorilla sitting in the corner. Because convergence is very difficult for us because you have two boards trying to agree to do the same things, even though each board is independent. So it's very tough, but we are doing everything we can to try to make US GAAP as similar as IFRS, or to make IFRS as similar as possible to US GAAP. We developed IFRS 9 on our own. At the same time we were developing IFRS 9, the FASB, our US counterpart, was developing US GAAP. Okay. When they finished developing this particular standard, we sat down and we looked at them and we said, what are the differences? What are the things that we can maybe bring the two closer together? So when we opened phase 1, part of what we were trying to do was to bring us closer together, to bring us into the same place, if we could. So a couple of the changes that we wanted to make. The cash flow characteristics tests. We wanted to have a look at the cash flow characteristics. We wanted to relook at bifurcation, because a lot of people were telling us bifurcation was easier. Your comment is exactly what they were telling us, is that, do you realize there's going to be less in amortized cost? We would rather bifurcate, so we looked at that. We wanted to look at the way our model now, this IFRS 9 model, worked in the context of the model that we were developing for insurance and in the context of the FASB's model. So, first place we did. Remember I told you this slide right at the beginning, this was the really important slide. This told you about how the whole model worked. Told you to make a printout of it and stick it on your wall and remember this slide. Well, now I'm going to tell you why you probably shouldn't have done that. You shouldn't have done it because we've changed it. How have we changed it? We've talked about introducing a third business model. So we've got a business model held for trading, we've got a business model collect cash flows. We're now talking about introducing a third model in the middle of that. And that third model we call fair value OCI. But if you look at fair value OCI, it looks an awful lot like available for sale. Okay. What fair value OCI says is I fair value the instrument on the balance sheet, but I don't think those changes in fair value are performance, so I don't put them in the performance statement, I put them in the OCI statement. Why is that relevant to you guys? Because I think OCI is the biggest pain in the butt for you guys. I think OCI is a real misery because you've got to figure out whether it's capital, whether it's not capital, and where to put it. So this is a really big deal. Even more relevant, why does it affect the industries you look at? Well, it affects the industries you look at because the industries you look at have liquidity portfolios. And a liquidity portfolio is a portfolio where I buy it to hold and collect, but I also kind of buy it to sell it. I'm thinking that I might sell it from time to time. In fact, sometimes even my regulators tell me I have to sell it from time to time to prove that I can sell it. So I'm going to be buying it and I'm going to be selling it from time to time. So I don't actually have a hold to collect business model. I have a hold to collect or sell business model, and I can do either. It's not a trading business model, but it's not the other one. So this is introduced to have and this is one of those changes that we got some feedback on, and maybe I'll tell you in a second what the feedback says. So cash flow characteristics assessment, what have we done here? We've simply looked at the cash flows and we've tried to make it easier. And we've tried to make it easier by saying, yes, it is P&I, But P&I is not just a rules-based thing. P&I is a principle-based thing. So look at the way that you do the P&I. Look at whether, to quote the example that we discussed with the front table here, look at whether in principle, in practice, this is P&I. And the fact that I've got a little bit of a thing in my contract that says that I can sometimes do things, well, how do I use that thing in my contract? And if I use that thing in my contract simply to adjust rates to reflect what's happening in the market, then it's probably still P&I. If I use it to extract advantage from my clients, it's probably not P&I. So this is the wording we've got. The first feedback we're hearing is, yes, it solves the Danish problem. I have no idea at this point if it solves the Croatian problem, but that's something I'm going to have to go back and look at. No, it does not solve the Livra A problem. No, it does not solve the Chinese problem. So hopefully, as part of the letters that we receive back, somebody's going to come up with a really clever idea how we can solve Livra A and how we can solve the Chinese problem. And maybe it's simply saying that if there's a regulatory override, you need to look to the regulatory override, but otherwise you look to the principal and interest test. Okay, so what would we go through? This effectively just implies the way the test would work. I need to look at the interest, but I need to look at not the contractual terms, but the way the interest works. I need to compare it to a benchmark instrument and say, is it similar to a benchmark instrument, an instrument that does qualify? If yes, tick. If no, cross. Fair value or not fair value. The business model. So we've introduced the additional business model, as I said. First thing we've done is we've provided more information for people to understand. Because one of the concerns we had that we had heard under the previous models, people coming back to us and saying, well, I have a liquidity portfolio. I sell 10%. Can I still say I hold to collect? Or does the fact that I sell 10% mean I'm actually in amortized cost? I'm actually in fair value, I'm trading. And the answer we came back and we said, well, actually we always thought that was a trading portfolio. We always thought you were not holding to collect. Why? Because your business model on day one, you knew you were going to sell some of these assets. Your intention was to sell some of these assets. Your business model reflects in the past that you sold some of these assets. So it felt to us like that couldn't really be amortized cost. Now, I keep mentioning liquidity portfolios for banks, but the underlying investment portfolios for insurance companies, it's exactly the same issue. Insurance companies don't buy their assets and then sit back and wait for them to mature. They buy their assets, then they sell them in order to help them extend their duration, or they sell them in order to have cash to pay out their liabilities. So insurance companies also don't hold this thing purely to collect. They also have this mixed model. And so that meant that probably insurance companies wouldn't have qualified for amortized cost. They would probably have qualified for fair value. So we've just given a bit of additional application guidance on what kind of activities you should be looking for and what is the frequency and nature of acceptable sales. When is the sale acceptable? Credit event happens. I've sold my business, a whole business line. I've done something like that. And when is it unacceptable? When would we say that it actually means it's amortized cost? We also talked about bifurcation, and under bifurcation we considered 3 different ways of doing it. The current model in IFRS 9 is what we call asymmetrical. We bifurcate the liability in order to identify own credit risk. We bifurcate non-financial hosts, the inventory I spoke about, but we don't bifurcate financial hosts. So it's a bit of a different model. It's asymmetrical, so that was the one option to consider. The second one was bifurcation of both assets and liabilities. So we introduced bifurcation for everything. And the third option we considered was no bifurcation. We debated this at length, but in the end the decision we made here was that we prefer to stick with where we are. We think the answer we've got makes sense. Most people are telling us it works in practice. EFRAG did a survey of their members a couple of months ago, and I think reported back on it last month, so I think that's a public document in public record. And what that document found is that very, very few companies use bifurcation right now. It's just too difficult. It's too artificial. People don't like it, so they don't use it. So we were fairly comfortable that we could continue with the answer that we've got up until now. So the business model strategy, we've got the hold to collect. We introduced a new option. We've introduced this new option, fair value OCI, as I covered earlier. The way fair value OCI works, and it's sort of the way available for sale works, okay, is that I show the fair value of the instrument on my balance sheet. In my income statement, I show exactly amortized cost. No difference. It's precisely amortized cost the way everybody knows amortized cost. Below the line in OCI, I make my balance sheet balance. So I say, how much do I need to adjust my comprehensive income in order to make sure that I'm now back at fair value? So what I've got is I've actually got two presentations: fair value on the balance sheet, amortized cost in the income statement, and OCI, which is like my parking lot. It's where I put all the stuff I don't know what else to do with. I put this in OCI because that's where I need to balance my balance sheet. The important thing here is that if I'm looking at the income statement, I'm going to see the instruments treated as though they were fair value, as though they were amortized cost. So what does my new example look like? Contractual cash flow test. If I fail contractual cash flow test, in other words, if I've got an embedded derivative in the instrument, I go straight to fair value profit and loss. No questions asked, it's a fair value instrument. If I satisfy that test, I then need to go through a second test, and I look now to see what my business model is. Is my business model hold to collect? Then it's amortized cost. Is it both hold to collect and selling? Then it's fair value OCI. Is it neither of those? So I failed test 1 and I failed test 2, it's fair value profit and loss. So my residual category here is fair value profit and loss. That's where everything goes that fails the 3 tests. It ends up in that particular one. The rest of the tests are positive. Okay, now, people have already asked us, why don't we have 3 positive tests? And the reason why is that you might fail all 3 positive tests and then what? So then you've got to go somewhere. So the reason why we have a residual category is to reflect the fact that you might fail some of those tests. We've had a couple of comments. I can give you some of the initial comments and the feedback. The first one is, the first question we asked is, should we have this third business category? 1/3 of our constituents came back and said, yes, exactly the way you proposed it. 1/3 came back and said, yes, but as an option. 1/3 came back and said, no. That means no matter what we decide, 2/3 of people are going to be unhappy with us, and 1/3 are going to be happy with us. So it's kind of a difficult decision because there doesn't seem to be a good answer in this space. Couple of suggestions, though, that have been fairly good that we will think about. The first suggestion is maybe the residual category should be amortized cost. It should be fair value OCI, so it should be the middle category. It's easier in some ways because then what you do is you define the 2 extremes. I define what hold to collect is. I define what trading is. And anything that is not trading or not hold to collect is in the grey area in between. And the grey area in between is fair value OCI. The way we're doing it at the moment is we're defining the bottom category, amortized cost. We're then defining the category on top. And now the problem becomes, the real difficulty becomes, the grey area between amortized cost and fair value OCI. So maybe doing that, and that's a good suggestion that I think we're probably likely to follow. The other suggestion we've had is maybe we should give, like we have a fair value option for profit and loss, we maybe need a fair value option for fair value OCI. And again, it would be you would only exercise that option if it is to eliminate a mismatch. So if I've got a liability at OCI, I can fair value my asset at OCI. Okay, financial liabilities. I just want to see if there were any changes here. Pretty much kept exactly the same way as we had it before, no changes there. Where we on convergence? Well, the 2 boards actually agreed on most of the changes we've suggested. So we've come very, very close on those convergence. We've got answers that are actually very similar to each other. And that's the end of the presentation. Any questions on IFRS? Any final questions on IFRS 9?